Hello, my name is Brenton Harrison, the founder of Ultra Borrowers Academy, an online course where we help people with a mountain of student debt take back control of their loans. And we're here today to talk about how to get a defaulted student loan removed from your credit report. Let's get started. If you're watching this video and you've never been through the process of dealing with a defaulted student loan, then I definitely hope it's something that you never experienced because it is an awful, awful thing to go through. If you have a federal student loan and it's gone into default, that means that you've gone at least 270 days without making an on-time payment. And when you do that, your loan goes from in good standing, first into delinquent, and then lastly into defaulted mode when it comes to your status with the federal government. Now, there are a number of negative consequences that come as a result of you having a defaulted student loan. It makes you ineligible for certain repayment programs. It makes you ineligible to have your loans forgiven under things like public service loan forgiveness or income-driven plans. It can even lead to your wages being garnished, where you're getting money taken directly out of your paycheck to go towards restoring that defaulted loan. And you can also have your tax returns garnished as well. But in today's video, we're going to talk about how to get this defaulted status removed from your credit report, because another big issue when it comes to a defaulted student loan that you see is that you have a status on your credit report of a loan in default. Now, that's a really big deal because if you're applying for new debt for things like a home or a car, it could prevent you from getting that loan if you have a defaulted student loan. But even if you're not trying to get new debt, having a default on your credit report can keep your score low for a very long time. So when you have defaulted student loans, the two things that you'll see is you'll see the late payments from your initial status where you weren't yet in default, and then you'll see the formal default status on your credit report. And today we're going to talk about how to get that off of that credit report. There are three main ways that you can get a defaulted student loan out of default, but only one of those ways will actually remove the defaulted status from your credit report. Now, the first option that you have with a defaulted loan is you could pay it off in full. We're not going to spend a lot of time on that because if you had a student loan that's been in default because you've had at least 6 months or 9 months of late payments, it's highly unlikely that you can pay it off in full. So we're not going to spend a lot of time on that. The second option is you can consolidate those defaulted student loans. So when you have federal student loans, every single semester that you take out a loan, that's a different loan. If you were in school for 4 years, you might have 8 different loans that you see that are all wrapped up under one umbrella. Now, the payment that you're making or not making that led to you being in default could mean that all 8 of those loans are now in default. And oftentimes you'll find that those loans may be with one servicer while you're in good standing, but they actually might send it to a different servicer to help manage the collection process of trying to get the money from you to pull it out of default. So one option that you have with those loans is you can actually consolidate those loans into what's called a direct consolidation loan, which would basically be when you go to your loan servicer, you take all 8 of those disparate loans and you consolidate them into one umbrella, and now you have one new loan. Now, in that process, when you consolidate, you do get your eligibility back when it comes to certain income-driven plans or repayment plans under the federal loan programs. You regain your eligibility to have your loans forgiven. You can even put yourself in a position where in some cases you can stop your wages from being garnished or your tax returns from being garnished. But there are two main problems with this. Number one, if you do it, you are not able to remove the default from your credit report. It will stay on there as well as the late payments. But the other problem is when you have a student loan that's gone into default, oftentimes there are collections fees and extra interest and penalties that the lender who's trying to collect will add on to your loan balance. And those can add up really quickly. So you might have a loan that went into default at $50,000, and now all of a sudden you're trying to consolidate loans that total $70,000 because of all those penalties, interest, and fees. Well, unfortunately, even though you do restore a number of the privileges when you collect and consolidate those loans into a new loan, you do not have the opportunity to waive those interest, penalties, and charges. So all of that would be added onto your debt. And instead of 50,000 in this example, you would owe 70,000 on that new consolidated loan. So since the purpose of this video is to show you how to get the default in particular off the credit report, the consolidation is an option that may be helpful, but it doesn't exactly reach the purpose of what we're trying to do by getting that taken off off of what your lenders are going to see when they check your score and they check your credit. In order to do that, you have to take advantage of the third option, and that's student loan rehabilitation. Student loan rehabilitation is a program where over 10 months, the government calculates a payment that they think is reasonable based on your income, and they ask you to make 9 voluntary on-time payments over that consecutive 10-month period. If you can do that, then you can actually pull your loan out of default and have all of your privileges restored without having to consolidate your loans. Now, when it comes to that reasonable payment, the first option for making that payment is having your lender or the default lender look at your adjusted gross income from your previous year's tax return or whatever income information you provide that they'll accept. They do a calculation to find your discretionary income. If you've watched our videos on the income-driven plans, we've talked about how they calculate that discretionary income. We'll show you an example in this video as well. But when they find that discretionary income under student loan rehabilitation, the first option for payment is to pay 15% of that discretionary income during the period in which you're trying to rehab your loans. Now, there is an option for people who cannot make that payment to submit their bills, to submit their expenses and their income to their lender to have that payment be decreased. But the default option is going to be 15% of that discretionary income number during the rehabilitation period. Now, you could be in default status and going through the rehab process and have already had your wages or tax returns garnished. Unfortunately, if you're in rehab, those wage garnishments and tax garnishments will continue, but you can't use the money that they've taken out of your check to count towards your rehab. I'll give you an example. Let's say that you're having $500 a month taken out of your check. And when they do the rehabilitation process, they find out that your payment for rehab will be $600 a month. Well, you would hope that the $500 of your wages that are being garnished would count towards the $600 you have to pay in rehab, and you could just pay an extra $100. But unfortunately, that wouldn't be the case. In this example, you would have to pay the $500 in wage garnishments plus an additional $600 a month until you've gone through the rehab process, because you can't use garnishments to count towards your rehabilitation. Now, if you can get through that and you can make it through that period of time, then what will happen is you can find yourself in a position where your discretionary income payment will allow you to get out of this hole that you're in. Here's the calculation for discretionary income. It is either your salary or income information or a number called your adjusted gross income, which can be found on your previous year's tax return. They take that number and they subtract 150% of the federal poverty level. The federal poverty level is just an amount of income based on the people in your household, where if your household makes that amount or less, you're considered impoverished. It's an amount of income they use to determine who's eligible for certain social services. But in this example, you can actually see in 2020 for a family of one, it's $12,760 for the year. For a family of two, it's $17,240, so on and so forth. So your lender is going to go through this calculation. We have an example here of John Doe, who lives in Tennessee and has an adjusted gross income on his last year's tax return of $75,000. So his loan servicer is going to take that $75,000 and they're going to subtract 1.5 times the federal poverty level for a family of one. Now, in this instance, this leaves him with a discretionary income for the year of $55,860. And remember, as a part of this rehabilitation, he has to pay 15% of this discretionary income for the year as a part of that 9-month or 10-month process. And that leads to a monthly payment during rehab of just under $700 a month. So definitely not an easy thing to do, but if he can find a way through that program, 9 payments over that 10 months, there are a number of benefits in addition to what we've already discussed. The first, and the whole purpose of this video, is that when you go through rehab, it removes the default from your credit report. Now, unfortunately, the late payments remain. And as long as you have a late payment, it will stay on your report until 7 years from the date that that late payment was reported, not the date that the late payment was missed. The date from the late payment was reported, it will stay there for 7 years. But the big part, the default, will be taken off of the credit report. You also, when you have a loan rehab, can see some of those collections fees wiped off, which can be a big deal when you have a lot of that interest and penalty taken away to lower your loan balances. You can see wage and tax garnishments decrease or cease, and it also restores your eligibility for all repayment plans, all forgiveness programs, and even additional student loans. It even restores your eligibility to do things like deferment and forbearance. So there are a number of benefits to going through this process if you found yourself in a position where you have a defaulted student loan. My name is Brenton Harrison of Ultra Borrowers Academy. I hope this video has been useful to you. If you haven't already, subscribe to our channel and click the notifications button so you'll be notified when new videos are dropped, and we'll keep new content coming for you soon. Have a good one.